Welcome to the Daily Update, where I'll go over the action in the market for Friday, July 28th, and then we'll see how things look for Monday, July 31st. Had a bit of a rebound after the tough day that we saw on Thursday. We're kind of shifting back more now to an overbought situation in the short term, a little bit in the intermediate term, but we are seeing some improvement. So far, it looks like the decline that we saw was just a short-term pullback. Now we're still coming into a seasonally weak time at the end of July as well as the beginning of August. We'll have to see if the market can still continue to hold up. Let's go back and talk about what happened. Right at the open, we had a gap higher open with prices climbing above R1 at 45.87. As the day went on, prices fell back to below yesterday's daily pivot. That's as close as I could come to finding some kind of a support level. And then we climbed back to almost R1. Prices then ended up closing below R1. We were up 0.99% on below average volume. That's a little bit of a concern to have an up day and volume dropping off. The technicals are still positive. We're still getting into that overbought situation, and the market continues to be fixated on inflation and interest rates. What are some comments that we can make? The Bank of Japan, they voted to change their yield curve policy so that they have more flexibility. They're going to keep their target rate at 0.5%. They're going to go ahead and purchase Japanese bonds at 1% every business day through fixed rate purchase operations. They're really trying to improve the situation there. We'll see if it ends up working out. On that news, ultimately the yen did weaken against the dollar. Mega caps had another good day on Friday. Earnings and economic reports that came out were pretty much taken as positive, and we're still asking that question about this positive scenario, that we'll have a soft landing, that the Fed is almost done, that future earnings growth will continue. On a short-term basis, we have the Williams percent R and our stochastics that are extreme positive. Intermediate term, we have the rate of change, 50 periods again, the PMO studies, the Sean Trend Meter, and the bullish percent index for the S&P 500 as well as the NASDAQ 100. Long term, we still have the 150 and the 200-day moving average study that's looking a little extreme. The dollar was down and interest rates were down, and this gave some support to stocks. All of the yield curves that we watch are still inverted. Sentiment is still extreme. 75 is when it changes back down to positive. We're now at 78. Our trend is positive, but the green line continues to come down. The ADX is still above its moving average, suggesting that we're in a strengthening trend. Both of them are above 20, but they're also getting close to that 40 level. Our bias is positive with the up day, and our momentum, I'm still keeping it mixed to positive. The economic reports that came out, we had personal income up 0.3% month over month, lower than the 0.5% they had expected. Last time it did come in at 0.5%. Personal spending was up 0.5%, more than the 0.3% they had expected and more than the 0.2% that we had last time. The PCE price index came in as expected, being up 0.2%. The core PCE price index, this is the important one that the Fed likes, it was up 0.2% as expected. On a year-over-year basis, the PCE price index is up 3%. Last time, it was showing that it was up 3.8%. Then the core on a year-over-year basis is up 4.1%, less than the 4.6% that we were seeing last time. The second quarter employment cost index came in up 1%, less than the 1.1% they had expected. Last time it came in up 1.2%. Consumer sentiment came in at 71.6, a little bit less than the 72.6 they had expected. Last time in the preliminary reading it was at 72.6. A month ago it was at 64.4. If you look back a year ago it was at 51.5. Here are some charts to show you. Here is the PCE index showing over the last year how we have been declining. The month-over-month change did tick up just a little bit. We're above zero, but we're not showing a lot of explosive growth right now. The personal income and spending. The blue line is the spending where it is trailing off. We're flattening out a bit with the income and it declines slightly. The core inflation rate, this is the important one. Year over year still shows a decline in inflation. Personal spending month over month did see an increase, and the employment costs were going down on the total. That's the blue line. The yellow line are wages, and the purple line are benefits. Looking at the final reading for consumer sentiment, it came in at 71.6, showing some improvement here, but there's still a wide spread between sentiment and the 2-year yield, even though it is declining. Here's another chart showing the consumer sentiment gauge. The total is the blue line, where it's ticking up a bit. The yellow line are the expectations, what they think will happen going into the future, and how do they feel right now is the purple line. Looking at some isabelnet.com blog charts, this is from Real Investment Advice, again suggesting that earnings projections are still well ahead of economic realities. Then looking at the S&P 500, right now we're at about 4,600, with the trailing 12 months being at 220. These are the different levels that they come up with. They just sit down and figure this out in a spreadsheet and come up with where they think we should be. We're seeing some inflow going back into tips. Interest rates have been going back up again. There's a little uncertainty there. These are the shorter term bonds that can mature and you can roll over into a higher interest rate if rates keep going higher. We're seeing inflows also for tech over the last 6 weeks. It's declining a little bit, but there's still a lot of money going into that sector. We're looking at the Magnificent Seven. Right now we're showing the market cap is 28.6% of the overall market. The cash allocation versus the long-term average, we're still showing this a little bit below average. Are you more likely to increase or decrease your bond portfolio over the near future? 25% say they will increase their exposure. Getting into our charts and analysis, here's the intraday chart. We had a pretty big gap right at the open. We did make it up to R1. The pivot levels were quite far apart because of the wild swing that we saw on Thursday. We came up here, we topped out at about R1, we fell back down. It looked like we found some support at just about the daily pivot for yesterday. We bounced back up, almost made it to R1, trailed down a little bit, and then saw a little bit of strength going into the close, and we closed just a little below R1. Here's the intraday chart. We were looking pretty strong in the pre-market session. They liked what was going on in Europe, and then we got the economic reports, and that helped the market to really shoot up higher. Here's the middle of the day weakness, and then we're pretty much flat as the market closes going into the weekend. Overall, growth did outperform value. The blue line is above the red line. So on a closing basis, growth did outperform large caps. They underperformed just a little bit with the mid caps and did outperform with the small caps. Here's our growth to value ratio for the S&P. We're above the dashed line. It's positive and showed some good strength. Looking at sentiment, we're still not showing a lot of fear in the market. Our Ulcer Index continues to be very low. The VIX did tick down on the line chart as well as the bar chart. The VIX of the VIX is also showing a decrease in volatility of the VIX. We're seeing this correlation coming down between the VIX and the S&P 500. As this is going down, that typically will happen as the market is going up. We're looking at the equity put call ratio, 5-period simple moving average. We ticked down just slightly. We're still wondering if we bottomed and will continue to go up. That would be negative for the market. So as we're going back down, that's more positive for the market. Looking at a longer term version of that same chart where we are coming down and now ticking back up slightly. But on a longer term basis, the equity put call ratio is still declining, and that is positive. This fear gauge that we look at did decline, and we're also declining overall. We're also seeing the other fear gauge continuing to decline. We had the latest reading of the active asset managers, and I'll go over this again in the weekly video. They're getting pretty extreme positive. They're above 100. And this could start to suggest taking a contrarian view of things. Then looking at the risk on, risk off ratio, we did tick back up a little bit. We got hit earlier in the week, but the last couple of days it's come back up. Our advanced decline line, we saw a turn up based on price and volume, and this is still looking pretty healthy. We did see an expansion of the new highs. We are trailing off just a little bit here. Our 5-period moving average is pretty much flat, and we're flattening out with our 10-period moving average. The advanced decline ratio ticked up just a little bit, but it's still above 0. That's positive. We're still keeping an eye on this. Accumulation distribution. It turned up, but it's still below the moving average. This tries to measure what the smart money is doing. The cumulative NYSE advanced decline line showed a lot of improvement. We're still not breaking out above these previous highs. We're also showing a little bit of improvement with the regular advanced decline line. Then this other advanced decline line did tick up and we're well above this upward sloping trend line. When we look at common stock, saw a little bit of improvement based on price as well as volume, but we're seeing a bit of a negative divergence as volume is lagging behind price. All of our advanced decline line studies showed improvement across the board and we're above the moving average. Looking at our trend, getting back up above that 40 level, nothing magical about that, just sometimes that will suggest that we're extreme positive, but at the same time it can also suggest good momentum. So we're above the moving average. The green line is declining though, which is strange on an up day, but we would still default to the positive because the green line is on top. Shorter term, seeing pretty much that same thing. Above 40, above the moving average, but the green line is declining. Volume still is dropping back down just a little bit. It was above average on Thursday, but then dropped below average on Friday. Our short-term chart, we're still battling the underside of this upward sloping trend line. We'll have to see if we can keep going up from there. We also have some other pivot levels that can act as overhead resistance. On the bottom, we see where volume did drop to below average. The 20-period double and triple exponential moving average, we're coming right back up to those levels. So right now, in the short term, this continues to hold. The 20-period exponential moving average ticked back up and is no longer extreme. Turning back up with the 50, also not extreme, showing a little bit of an improvement with the 200. The Williams percent R is starting to get extreme positive. The stochastic, short-term extreme positive, we're still extreme positive in the intermediate term, but we're going down, turning back up slightly with the long term, but we are also extreme positive. The force index is above zero and advancing. That's positive. Looking at some intermediate term charts, the balance of power was pretty much flat, but we're above the dashed line, suggesting this is positive. Looking at the 50-period double and triple exponential moving average, so far the double has held up as support. We came down to that level and then came up from there. The go-no-go system still remains more neutral to positive with the lighter shade of blue bars. The highest high value, we're getting back up to the top, but we're going sideways overall, but this is still suggesting that we're slowing down, but still positive. The TTM squeeze, still showing a little weakness. We have the darker colored blue bars, and the oscillator itself is flattening out. We're still getting back up into the third standard deviation now, suggesting that we might be overbought, but we're not as high as we were before. This could also suggest good momentum. The rate of change going back 50 periods, also looking extreme positive or could be good momentum. The Erin indicator flattened out just a little bit. We saw a bit of a decrease in buyers, a bit of a decrease in sellers, so that's why our oscillator rolled over a bit, but it's still positive. We were able to get back above zero with the S&P McClellan oscillator. That will help the summation index, so we're turning back up slightly based on price and starting to go above this previous high. We're continuing to decline based on volume. That's a little bit of a concern. The NYSE McClellan oscillator also was able to get back above zero. So based on price for the NYSE is showing improvement as well as based on volume. But on this chart, we're seeing where price is lagging a little bit behind volume. Where volume is breaking out, price is lagging. The Swenlin trading oscillator still declining based on price. We turned up just slightly based on volume. A little bit of a mixed signal there. The PMO is still rolling over more negative. We're turning down based on price, but still positive. We're starting to go negative based on volume. We saw a bit of a tick up with the PMOs that are rising. We're still declining with the buy signals, and we're flattening out in an extreme positive reading with the PMOs that are above zero. The Elder Impulse system for the S&P has switched back to positive with a green bar. The parabolic SAR continues to be positive. The slope oscillator continues to show a decline. The MACD also is showing a decline. So looking at all of our oscillators, we're turning more negative in the short term. We're flattening out in the intermediate term, still seeing some improvement in the longer term. The Sean trend meter is still extreme positive and it turned up. The BPI did see a decline on an up day. It could be working off some of this overbought condition, so we're seeing a little bit of weakness here. The NYSE bullish percent index is also rolling over but still above 50. It's positive though. The Chaikin money flow continues to decline. We're wondering, is the smart money starting to pull out? We're below the moving average, even though this is still positive. The Chaikin oscillator ticked up just a little bit, but is below zero and overall has been declining. The money flow is above 50 and advancing. The ultimate oscillator is advancing, but still below 50. The vortex saw the green line turn back up slightly. That's positive. And then looking at the RSI 14 and 9, we're coming back up, but we're not quite extreme on the 14 or the 9. We're wondering, is this going to develop into another negative divergence? On balance volume ticked up and is above an advancing moving average. Looking at the 200-day simple moving average, we did turn down just a little bit and we were flat with the 50-period moving average steady. The copy curve starting to roll over a little bit here, but hasn't quite crossed negative yet. The Pring bottom fissure still continues to generate a buy signal. Our Fibonacci and line studies, we are coming up to the 50-day period now on August 1st. That will be the end of this cycle. We'll have to see if that has an impact on the market. Our charts are still positive across the board. The Heikin Ashi is looking good. The Kegi chart, even though it ticked down just a little bit, is still positive. The Renko continues to be positive, and the 3-line break is also positive. The equal weight index is starting to perform about the same now as the S&P 500. That's suggesting more broad participation. The equal weight to S&P 500 ratio did tick up slightly, but we're seeing this declining overall. Keeping an eye on Dow theory, we were up with the Dow, we were up with the transports, we were down with the utilities, which gave good support to the S&P 500. The transports to S&P 500 ratio is now back to advancing, and that's what we would like to see in a solid environment. The transports are now starting to outperform the Dow. And looking at our discretionary and staples equal weight study, we were pretty much flat with discretionary. We advanced slightly with the staples, so our ratio ticked down, but still overall discretionary is outperforming staples. The Dow is still above this pivot level and was up 0.5%. We still continue to be neutral though for the Dow. The Nasdaq also was able to get above this pivot level, showing some improvement. But we're still keeping an eye on the 61.8% retracement level. So far, we're breaking above that. The new highs, new lows for the Nasdaq still are showing weakness on a cumulative basis, even though they're turning up, and we're slightly positive with the raw score. The Nasdaq 100 was also able to get back above this pivot level. That is positive, and we're still above the August 2022 high. If we see more follow-through upward action, we'll want to see if the Nasdaq 100 can break above this R1 level. The Qs have switched back over to positive after being neutral, and the Nasdaq 100 bullish percent index is also showing some improvement, but is extreme positive. We're also keeping an eye on this negative divergence that we're seeing with the Nasdaq 100. We were making a higher high based on price, a lower high with the PPO, and we continue to be negative even though it turned up slightly. The small cap index is still above this support level and was up a little less than 1% on Friday. We're still below this resistance level with the Russell 2000. We want to be able to break through that if we're more positive. We're working off of a recent golden cross. The MACD, though, is showing some weakness, although the RSI is turning back up above 50. The small caps remain neutral for the Elder's Impulse system. And the small cap ratio did tick up a little bit compared to the S&P, but overall it continues to decline. When we compare small cap growth to value, we saw a little bit of an improvement, but we've been chopping sideways, although we're still in an uptrend. The mid caps are still maintaining support above this pivot level, and the mid caps remain neutral for the Elder's Impulse system. When we compare growth to value, we saw a bit of a turn up, and we're seeing more longer term strength with mid cap growth versus mid cap value. Checking in on the home builders, not really seeing anything all that distressing. We were up with the S&P, up with the home builders. The ratio is going up, and the correlation between the two is still pretty strong. The dollar was down just slightly, but is still above 100. We're still dealing with the FANG index. We have not been able to get back to the previous all-time high to try to set a new all-time high. When we look at the S&P 1500 and compare it with shorter-term bonds, stocks are still outperforming bonds. Also in this other indicator, we're seeing that stocks are outperforming bonds. The tech sector is outperforming bonds. And the Qs, which means the Nasdaq 100, are also outperforming bonds. The S&P continues to outperform bonds, suggesting that we might see a soft landing. Home construction continues to look really well in spite of the uncertainty that we're seeing with interest rates. Growth of value did see a bit of a tick up after seeing some weakness earlier on, but it is showing some improvement overall. Keeping an eye on the banks, we were up 1.21%. We've been able to get back above the 200-day moving average. The financial sector was also up, but we're not quite ready to get a golden cross yet. The financials underperformed the S&P 500 and continue to do so longer term. The regional banking ETF did show some improvement compared to the financial sector, but still is in an overall downtrend. Keeping an eye on bonds, we were down slightly based on yield, and we were up based on price. We're still below the 200-day moving average. The MACD is crossing over negative, and we're below 50, although we are advancing with the RSI. Value to growth ratio compared to the 10-year yield, we're seeing that they're having a tendency to go in the opposite direction. Folks are still favoring more risky bonds over more conservative bonds. This is still a concern, though. We want to see this ratio going down when we look at cash versus the 3 to 7 year bond ETF, but it continues to go up. And I haven't shown this chart in a few days, but this is the 3-month yield. It still is continuing to go up. We don't know if this turns and comes back down. Is that going to give us some kind of a warning sign like it did back in 2007? Our long-term charts were still positive with the special K on the daily chart. The weekly chart is negative, but is showing some improvement. We're still looking a little toppy with our 150 and 200-day moving average study. And we're still above this resistance line with the weekly chart of the S&P 500. We're also above this line with the NASDAQ 100. The ratio between the NASDAQ 100 and the Dow is still giving us a pretty high reading. We're wondering if it's going to continue to go up or drop back down. If we see this really start to drop down, that could be negative for the NASDAQ 100, which could then feed over into the S&P 500. Our possible positive scenarios saw some improvement here with the Qs outperforming the S&P, a little bit of a tick up with discretionary to the S&P, as well as a tick up with the large cap growth versus large cap value. Our growth to value ratios, large cap, a bit of improvement, turning up a little bit with the mid caps and also with the small caps. The S&P to utilities ratio ticked back up slightly. We want to see this going up. If you're positive on the S&P, that often gives good support. We're still above zero with our broad range of the highs minus the lows, taking a 5-period moving average. We're still at this upper range area with the 10-day average of the S&P high minus the lows. We've been camped out there for quite a while. Looking at S&P growth versus value, it ticked up slightly. It's been chopping more down, but it's still in an overall uptrend. We want to see this chart show some improvement. The 50-period exponential new highs minus the new lows continue to advance. Our indicator is still above zero. The red line continues to go up. The Staples S&P 500 ratio ticked down just a little bit and has been declining overall. That often gives good support to the S&P. So what's our outlook for Monday? We're going to have a lot of earnings reports coming out, and some of those can be really influential on the market. The technicals are positive, but now we're back to going into an overbought condition again. So that's a little bit concerning. The economic reports coming out on Monday will be just the Chicago PMI. We're keeping an eye on all of the geopolitical events, but the market is still fixated on inflation and interest rates. Here is the economic calendar for the upcoming week. There will be a lot of important reports, but the one that's going to be the most influential will be the employment situation report coming out on Friday. Stock Traders Almanac statistics for July 31st. We're coming out of the options expiration week, so that's gone now. But for the Dow, the S&P, and the NASDAQ, we are negative across the board historically. We're on the last trading day of the month, which is the 20th day, where we do tend to see some historical weakness. We're also seeing some weakness for the NASDAQ coming into the end of July. This is another look at August, just to see how we see some initial weakness at the beginning of the month. We might see a bit of a bounce going into the middle of the month. We chop around later on, and then sometimes see some strength going into the end. This is another graphical look at the month of August, where we are a little bit weak starting out, then we see a little bit of a bounce back. The middle part of the month is where we see some strength, and then we tend to see some improvement as we get later in the month. Then going back to 1950, in pre-election years, we're 50-50 as far as historical averages. So our scenarios can't go with the down one yet. The technicals are positive, even though they're starting to become overbought again. We're going with the up one, and we would default to that, but be aware that we are becoming overbought yet again. We're not in a sideways trend now because our ADX is suggesting we're in a strong trend. The green line, even though it's declining, is still on top, so we default to positive. Our warning signs, we're wondering if there's going to be this convergence of these short-term bearish signals. So far, they kind of come into play and then kind of sneak back out as quick as they entered. The longer-term trend signals may be signaling a top. Those are the weekly charts for the S&P and the NASDAQ 100. We're still above those levels, so we don't know if that's a top yet. We don't know if the market's going to be able to break above that or eventually is going to come down below that. We're coming into a seasonally and historically weak time of the month. That's the end of July and the beginning of August. Our oscillators are turning more negative, especially in the short and intermediate term. We're also keeping an eye on the NASDAQ 100 oscillator. The VIX is showing that there's not a lot of fear. The cumulative new highs, new lows continue to decline overall for the NASDAQ. The 3-month yield is still back above where it was in 2007. S&P growth is weakening, but it's still in an uptrend, but it's been chopping more sideways. And then we're dealing with earnings on a case-by-case basis. The positive signs, we have seasonality and setups. Those are in the background, and I'll be going over those in the weekly video. The special K on the daily chart is positive. The weekly chart is negative, but looking a little bit better. The long-term equity put-call ratio is still positive. We're still above the downtrend channel upper line for the S&P. We're still in a risk-on posture. Lower price levels so far have been providing support. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they're above overhead resistance, but they're still below daily pivot resistance. The Staples to S&P 500 ratio is declining. The Russell and the small caps, as well as the mid caps, are working off of recent golden crosses. Small and mid cap growth continues to be positive. The Copic curve and the Pring bottom fissure have generated buy signals. The Copic curve signal just might be getting ready to go away. So our conclusion, overall, the S&P remains positive, but now it's back to becoming overbought again, which also can suggest good momentum. In the short term, positive, becoming overbought. Intermediate term, also becoming more overbought. Long term, we still remain positive, unless you're keeping an eye on the 150 and 200-day simple moving averages. Thank you. I hope you found this helpful. Have a really nice weekend, and I will talk to you in the next video.